Hey Shane, how's it going?
Terribly. I should have flattened all of my short trades before this morning's data release, but instead I didn't, and I paid the price this morning. So I gave back many dollars worth of gains in all my short positions that were killing it. So yeah, big bounce in the markets today thanks to some CPI data coming out, which of course we'll get into in a moment, but I've had better days, my friend.
Same here. Much like you, I was short going into that report and I learned a lesson. Sometimes you got to get reminded. You get a little confident, try doing something aggressive, and that's not the best way to trade, but we all mess up sometimes but we got to keep those losses small and move on. So, with that, today it's November 10th, and please anyone, if you've got questions, comments, whatever, throw it down in the comments section. We'd love to just address anything that's on your mind, but you know, with that, let's go ahead and just step into it. So you can read this quick if you'd like, just legal disclosure, but the big one. So CPI came out, markets are screaming, but we have some statements from the Fed. And first one, unemployment report should rise to 4.5% next year as the Fed interest rates bite. The jobless rate hits 3.7% in October. And the other statement by Fed Chair or Fed Harker there is, Fed needs sustained decline in inflation. And that's the key part is that one report is not going to do it. They've
That
got
was
to keep
yesterday,
up.
right? That was before the CPI print. Was
Yeah.
that from yesterday, Harker?
Yeah.
Or was that
hmm
this morning?
I think actually on this one, I think it was this morning was when
Hmm.
this one came out.
Okay.
So I've checked, but the main point here is that it's not one report and they have an objective, and that objective does not include, boosting the economy and helping jobs out. So,
Yeah, you're right. Harker was 9 o'clock this morning.
okay, perfect. So, yeah, good to keep that in context. I don't, Shane, if you got anything to add on that.
Nope. We got five Fed speakers today. I assume they'll all say the same thing, which we all know already. No surprises. Lori Logan didn't surprise me at all. There's a long way to go. I mean, we talked about this in pretty much every Elevate chat we've had for the past several months. This is not over.
Nope. So, you know, and Jerome Powell, just some of the statements, I think we brought these up last time.
Yeah, this was from last week. So as we make these ongoing rate hikes, let me say this, it's very premature to be thinking about pausing. We have a ways to go. We need ongoing rate hikes. So I don't know if anybody missed it, but inflation was 7.7% year over year. That's a far cry above the Fed's target. So yeah, just to remind everybody, this is the environment we're in, and until the Fed stops hiking rates, there's a limit to how high the stock market can go. Big rally days like today are signature bear market bounce behavior. So these violent rallies to the upside are generally speaking selling opportunities. There's only one that won't be a selling opportunity, and that will be the one when the bear market's finally over. Trying to figure out which one it is will cost you a lot of money. Um, so yeah, it's a little premature to be thinking about this being a bull market or the bottom being in.
Yeah. And something to add to that, when you get a bounce like this, if it's real, you're probably going to have a few days after where it consolidates, pulls back a little bit, and then maybe that's a good entry. But one day like this, I mean, this thing could reverse tomorrow. You never know, but it's not normal, healthy market behavior of a bull market to rally 5% and then just that's the bottom and here we go. So
Yep.
we'll see what happens. So here's the CPI updated, version that we did. I don't know, Shane, if you want to add anything to this. We've talked through it, but really it's May 2023 is when we see a spot where maybe the Fed starts laying off the gas a little
Are
bit.
there, did we put animations on this slide? I thought we didn't, but I don't see any of this stuff. Oh, look at that.
Oh,
There are
there
some.
we
So this is assuming that CPI continues to grow by 33 basis points per month. And then we use that monthly rate to determine what the year over year inflation rate will be. You don't remember what was the month over month all, was it? Well, it was pretty close to 30 basis points, wasn't it?
yeah, is pretty close to that.
What was
So
it? I think it's it was 4. CPI for all items rises 0.4% in October. as shelter, gasoline, and food increased. Anybody on the call pay for shelter? What about gasoline? No? Food? Do you buy food? Oh, so three things that we all spend money on increased this month, and everybody's buying the market up 5%. Good luck with that.
Yeah.
So anyway, this shows CPI growing by only 33 basis points month over month until the end of 2023. And it shows the little X's on the left. You see every month in which there's a Fed meeting. So in September of 2022, we had a Fed meeting. They hiked rates by 75 basis points. In November of 2022, just last week, we had a Fed meeting and they hiked by 75 basis points. We are projecting that in the December meeting, they hike by 50 basis points. And we've been projecting that for months. The whole market has been projecting that for months. The Fed has said very clearly that they're trying to get to a 4.5% rate by the end of the year, which is exactly what we need in December as a 50 basis point hike to get to 4.5% by the end of the year. So we and the markets have been expecting this I don't know what you want to call it. I guess this reduction in rate hikes from 75 basis points to 50 basis points in December of 2022. We've all been expecting this for months. So this morning the news comes out that CPI is 7.7% year over year instead of 8% is what was expected. And suddenly the market, this is what they'll say on CNBC or the Cartoon Network or whatever you watch, but they'll say that the market's now pricing in this 50 basis point hike. No, it's not. We've been doing that for months and it's been bearish the entire time. So I don't know. I think this is just one of those, random things that you see in markets. If markets were efficient, we would never have prices to exploit, right? So things don't just trade at their intrinsic value all the time. If they did, we could just buy the S&P 500 and forget about it, and the S&P 500 would never drop by 20% because everything's always priced accurately. So if it was priced accurately, you couldn't drop by 20%. So anyway, I don't see how any of this is bullish. When 50 basis point rate hikes from the Fed start being bullish, I want somebody to call and let me know. But for all of the history of the world, rate hikes have been bearish. They increase the interest rates in the overall market. They increase the discount rate at which you have to price future cash flows, and it just reduces the present value of every one of those cash flows that you'll get in the future. So in this scenario, it actually, because we're only projecting CPI grow by 33 basis points, and this month it grew by 40 basis points, which is more than 4% a year. It actually pushed out by 1 month our target for when the Fed funds rate will go positive. So now we're looking at May of 2023. There is a Fed meeting in May of 2023, but for now we're projecting that they do not hike at that rate at that meeting, and that because CPI is actually falling, the year over year CPI is falling, even though it's decelerating. I should say there's not deflation. Prices aren't going down. It's just CPI is increasing at a decelerating rate from 5.3 to 4.6 in May. By then, the Fed funds rate should be 5% at the top end of the range, and the midpoint will be about 4.875, and 4.875 minus 4.6 gives you a slightly positive real Fed funds rate. And from there, I would expect them to take a break. That's when it won't be premature to start talking about a pause. So they'll be talking about pausing probably in the March meeting. They don't have a meeting in April, and then by May, if it plays out this way, which it doesn't have to, CPI could easily reaccelerate, go higher, depending on what a lot of things do this winter. So no guarantees on this, but this is our best guess right now, is that the last rate hike is in March for this cycle, and Fed funds rate goes positive by May. But if you look out to October, you see CPI, the annual CPI start to flatten out at 4%, which is double the Fed's target 2%. And so maybe they have to begin hiking rates again if CPI doesn't actually fall a little faster, or if it grows by more than 33 basis points. Ideally, what we want to get to is down to like 20 basis points month over month. I think 1.16 basis points is actually a 2% annualized rate. So 33 basis points month over month is a little bit higher than what the Fed has historically been looking for or claims to be looking for today. And I think inflation is going to be with us for a while because those things that we talked about, um, well, especially shelter and food, those are sticky. Those are not transitory. They're probably going to stick around for a while. So anyway, that's a lot of talking for me, but I think this chart is the most important lens through which to view the market today. And until the Fed stops hiking rates, there's really no good reason for the bear market to be over. So what do you think, Kyle?
Pretty accurate on that statement. You're going to see some bounces here and there, but the fact of the matter remains that the Fed does not want growth, and you can bet if the S&P recovers here and starts racing higher, they're probably going to look at that and say that's one of the biggest assets, and we did not want that. We better hike the rates more. So
Yep.
we want asset prices to come down right now. That's what they're saying. So
And if they slow down to bail out Wall Street, they'll kill everybody on Main Street who's,
yep.
out there buying this stuff. So I don't think they're going to do that.
And then here's the big one. So this is the report or the CPI report broken out. So we have the 7.7 up here.
And that's
The
for
big,
all items over the past 12 months. So I know we're throwing out lots of percentages. For those of you who don't follow markets closely, sorry about that. It's just the way that it is. So 7.7 is the annual rate, right, from October of 2021 to October of 2022 for all items, including food, including energy, including shelter, including all these things.
yep. So, the big ones I highlighted here, fuel, that's up, almost 20%. And that could certainly pull back a little bit, but that's the one thing it's volatile, and crude oil is definitely playing into that. So crude oil right now, we've looked at that chart. We did get a bit of a pullback, but still looking pretty strong. And then utility services here, nat gas has been down, probably plays in there. And then I like this one, and this is a little healthier. The used car market's coming down a bit. That one was, challenging for anyone looking for a car. I was there, and it wasn't fun. And then,
I'm shopping for a new car right now, man. It's holy smokes, cars have gotten expensive. Wow. I mean, I don't know. I'm not looking at used cars. I'm looking at new ones because I like to lease cars and not take any depreciation risk of my own. But they've got them priced pretty tight right now, and even in the lease market, I'm not sure. I might end up buying a used car if these things keep falling. But they're falling from ridiculously high prices, so it's not like you're getting a steal on a used car right now. I have noticed, by the way, I got an email from a dealership because I'm looking for a car. They said that they can't set none of the cars that they're sending to auction are meeting their reserve price. So they're trying to sell them, on their own without sending them to auction, which means there's some pretty good pricing, like first come, first serve type stuff and stuff they just need to get off of their lot. But the inventory is going up fast. And I don't know, with food and energy and shelter costing so much more, a lot of people are going to be at AutoZone and at O'Reilly and places like that trying to figure out how to make their current car work for longer rather than going out and buying a new or used, a new used to them car, new to them used car, I mean. And so I don't know. I don't know what I'm going to do, but for the first time in my life, I don't just want to go get a new Jeep Grand Cherokee. I probably 95% chance I still go do that because I just like those cars. But for the first time, I'm not committed to that, and I'm actually looking and shopping around. And man, I just can't believe how expensive cars have gotten. It's
yeah.
wild.
And it's interesting on the shelter thing. I just had this conversation with my wife, but she mentioned, hey, maybe we should stock up a bit before prices go up on some items. And just got me thinking, I wonder how many Main Street people now are having that same thought of, food's still going up.
Yeah,
So maybe if we can put it in the freezer, let's go stock that thing up.
yeah.
And
None of this is calling for deflation, right? We're not calling for prices going down
mhm.
across the board. Food is going to be a tough one for a long time.
Yeah, and that's the danger. We talked about that in the past one, but when you have inflation, if it's too high, it incentivizes people to buy today. And when you're talking about food and those are the necessities people need, that's not a good thing. And that's where the Fed, they certainly want that one to come down. So
Yeah.
we'll see how it plays out. But, when it comes to the markets, this I call it bear market nonsense, but it's just what it is. You're gonna
And
have some,
we had to move this one up in the presentation because we're getting one of those wicked bear market bounces right now, 5% in a day. So,
yeah,
could easily run another 5% and we'll still be in a bear market. Could easily run by another 10 or 15% and we'll still be in a bear market. So, don't get too carried away because of one day on some crazy headline that doesn't even really make sense. Again, CPI, it's not like it was 2%. It's not like it came down or went negative. CPI was 7.7%. That means things are 7.7% more expensive. That is bearish. That is not a good thing. We're at all-time high rates of inflation, 40-year, 50-year high rates of inflation, and it's not slowing down very quickly. So there's not really a lot to get excited about on the bull side here. But I mean, there's probably going to be a rally, and we've already seen a 5% rally just today. That might start coming down. Never know. Might continue for a little bit longer, but at any rate, we're still probably in a bear market and the Fed's still hiking rates. So just be mindful that the market can bounce 20, 26% couple times, in a short period of time, and you're still in an overall long-term downtrend. You're still below the 50-day moving average. You're still below the 200-day moving average, and there's really not a lot to get crazy excited about. So
no,
maybe it's over. Maybe we just saw the bottom of this cycle. It's possible, but you don't need to jump in right now in order to make money on the upside. If the bear market's over, we'll have plenty of time to get in, and we'll have plenty of time to buy the next bull market on dips as that develops. So
yeah, and
don't
that's
get
where
carried away.
it is important if you're looking to get into this market, form a plan and put this in it. Know that the market can rally 5% a day and what you're going to do to, you know, react to that because trust me, I'm sure it's easy. You look at the market today and you get that FOMO mentality and jump in and we're just not quite there yet. So
Yeah,
we'll
by the
see.
way, 5% moves in these major indexes is the exact opposite of healthy behavior. That's not healthy. Think about that. If you thought that the markets were efficient, how could they ever go up that much in one day? I mean, that means they weren't efficiently priced yesterday. They weren't discounting in the future news appropriately, right? Like that's how it works. So, um, yeah, it's totally unhealthy behavior for markets to go up that much in a single day. It or down. They shouldn't drop that much in a single day either if the market is efficient. So,
Yep.
the markets are not efficient, and that's why we're in the business we're in, is because we think we can exploit those inefficiencies, and historically we've been able to do so.
Yep. And now let's turn to present day and looking at the chart. So here's the 50-day. It was coming down, tested this uptrending support line and got back up here, but we still haven't cleared the prior high, still haven't cleared the 200. I don't have a whole lot to add. The fact is, downtrend channel, yeah, we bounced, but we're just not over any levels that really get me too excited and declared a bull market. Shane,
And
do you have
again,
any?
this is the zoomed out view. So the big point
Yep.
here is just to see where we are in relation to, oh, go
Oh,
stay there. Where we are in relation to where we closed in 2020. So before the nonsense GameStop rally that was the year 2021. We're, basically erased an entire year worth of market performance. So haven't even bounced that much off the lows. Still could go much, much higher from here. No reason to panic buy this thing. And we're still not even above the highs that we saw from last week. So, um, you know, big day, but that's because we had a bunch of bad days leading up to today. Why is the market up so much today? Because it was down so much coming in. It's pretty simple, right? So if you go forward, yeah, just a little bit, we'll get a better look at, you know, the we're still not breaking the highs from about a week ago. Um, Broke them briefly and then pulled back, and so we'll see what happens. Could we run up to the 200-day moving average here? Sure, why not? We did that back in August, and it failed there and dropped to a fresh low. So I don't think there's a whole lot to get crazy optimistic about here. Could definitely roll lower. Certainly could go higher too. I'm not ruling that out. I just don't see any reason to get carried away with buying stocks on a day when they're up 5%. More likely, we will cover the gap that was created this morning and get back down to that 380 level. If it holds there, maybe you get constructive and um, and take a stab at buying some things. But again, until the Fed stops hiking interest rates, I think there's a limit to how high this market can go.
Yeah. And Shane, you mentioned a key point. When we come back and consolidate and hold higher lows, that starts to look really good.
Hmm.
One day you're going up 5% doesn't mean a whole lot, but if you consolidate and just keep grinding higher, that's a good sign. But it's not green light go until we cross that 200 day. Then I really start to say, okay, big picture, yeah, it's looking pretty constructive. But right now, just in this channel here. So
I mean, even if you bought at the 200-day moving average, when we break that, like let's say, no, go back.
yeah,
If you, let's say the 200-day moving average looks like it's right between 410 and 400. So let's call it 405, and the all-time high was 479. So 479, or 40, what, 479 minus 405. So that's 74 points, that you could go up here in the SPY. Um, That's 18% gain. If you just wait and buy, at the 200-day moving average when we break above it, that's an 18% gain back to the all-time highs. If that's not enough, then you got to take more risk and go and try and buy some today. But the chances are you're going to be wrong, and the market's going to go even lower from here. And it's just riskier to buy down here. Yeah, the upside is a little bit more, but not much more. I mean, add what, 15 points to that 74, so 90 divided by 389, 23% instead of 18%. But it's way riskier to buy below the 200-day moving average. To me, the risk reward isn't there, and I would just wait until we build a couple of higher lows above the 200-day, because you can see back in March, April, we cleared the 200-day, but it immediately pulled back below. It didn't build any higher lows above the 200-day, and so we went lower and still going lower. So
yeah.
I'm not getting crazy about this move. Just usually bounces like this are to be sold, not to be bought.
Yeah. And Shane, one thing I just thought I'd add is you mentioned risk. The other key point here is probability. If
Yeah.
you get over the 200 day, there is a higher probability you're going to be
Yep.
right. There's a lower probability you're right down here. So is it worth, trying to get an extra 5% when you're looking at, I don't know, maybe a 30% win rate? Or do you want to be 70% right up here and give up that 5%?
Yep.
So
Yep. Exactly.
Qs, same thing here. So, lower highs, downtrend resistance line right into the 50 today. Um,
Hey, hold on. Again, the point of this view, the
yeah.
longer term view, is to show where we're at in relation to the year 2020 close, which means that we've fully erased the entire 2021 year for QQQ, where AMC and GameStop were going up hundreds of percent on total nonsense, right? So we are still trading below where you could have bought the QQQ index at the close of business in 2020, right? So what's the point of getting carried away with buying here? You've got lots of upside all the way to 313.74, and you're still buying at where the market closed in December of 2020. Again, there's so much risk with buying right here. And you're still so far below where the market was trading almost 2 full years ago now. So, in relation, like, I just don't see any reason to get carried away. So we've given back all of those gains that everybody was so excited about in 2021. Oh, the market's just going to go up 25 or 30% every year for the rest of eternity, and then turn around and do what it's done this year. So be careful out there. That's the point of looking at it that far back. I find it
Yeah.
amusing that we're still that far below where the market closed in 2020 on the Qs. So if you want to go forward one, we'll see a little bit better what you were getting at, Kyle. There you go.
Yep. And big one here is just when we zoom in, we're still not making any new highs on this one. Stuck right at the 50. And, as you mentioned, Shane, big one here is to get pre-COVID high. We're still right down here. We're under the 2020 close. Um, Still a little more downside to go, maybe. You never know where that bottom is, but it's
Yeah,
just telling us
to me
it's
this
going
one looks
down.
real bad. I mean, I love to short things at the declining 50-day moving average.
Hmm.
I normally like to short things when they make a new low. That's usually my trigger, is sell things when they make a fresh low. But in something that's stuck in a bear market, making lower high after lower high after lower high after lower high, The declining 50-day moving average is a great spot to sell. And I didn't highlight any, but if you look back at that red line, every time that, well, pretty much many times when the price approaches the 50-day from below, it might go a day or two above, but then it pulls back to a fresh low, pulls back to a fresh low. So it's a pretty high win rate trade to sell at the declining 50-day moving average. And you can see that, the 50-day moving average is the medium term trend. So if it's declining, if the line is pointing down, then the trend is lower. The 200-day moving average is the long term trend, and it is declining. So, the medium and the long term trend is down. The ultra short term trend is higher. But yeah, this is, to me, it looks like a good spot to be selling the Qs. Again, the Qs technology stocks are heavily dependent upon cheap money and low interest rates, and we know that the Fed's going to just continue hiking at least for a little while. So um, no reason to get carried away on the long side. If you just wait until it gets above the 200-day moving average, there's a lot of return left there. And so, it's at 80 divided by about 300. That's 26%. If you wait until buy it over the 200-day moving average, if it just goes back to its all-time high. And from here, I think where we're sitting today, Qs is still down, probably close to 30% from its highs. I
Yeah,
don't
right
know.
around
Do
there.
you know the answer to that?
I think it was maybe
Yeah,
33% yesterday.
was going to say year to date, it's still down 30.22%. And from the high in November, yeah, 30.90%. Yep. So it's up 5% today and still down 30%. I have a hard time getting excited about that.
As do I. So, with that, Shane, just a quick update, but 60/40 portfolio, if you got 40% in bonds, 60% in equities, which historically, great way to go based on something I don't understand still, that American public didn't really invest like that 100 years ago. So the data sample is kind of limited in a way, but you're down 19.5%. You're not getting the protection that you were promised. And, there's a better way to do things, and that's actively managing that risk and not owning something that's so overbought like bonds were.
Yeah, and if you own the TLT, you're in even worse shape. So, if yeah, I mean the 60/40 safe and diversified balanced portfolio, right, is down more than the S&P 500. So the balanced portfolio, the pie chart prism portfolio is down 19.48. The S&P 500 is down 18.47. So having 40% of your money in bonds has done you zero favors all year long, and it's moved in perfect correlation. So you're not diversified and you're not outperforming to the downside. The 60/40 pie chart portfolio makes absolutely no sense in a rising interest rate world, and I think that's where we're going to be for bond markets move in 30-year cycles. So there was a 30-year bull market in bonds from 1980 until very recently, and there's probably going to be a 30-year bear market in bonds going forward. So be careful with those bond exposures.
Yep. So now let's look at some commodities here, Shane. But oil, you highlighted this last time. We keep hitting this line right
Oh, I
around
hit
that.
it again. I should have put another circle on.
Yeah, so I honestly, so I got a little excited here. I saw it came up, pulled back, consolidated, it went at it again and failed, came back again, and we'll see how it shapes up. Today we're bouncing a little bit, but we might try it again. But I'll tell you, once we break that line, it is all systems go.
Yeah, we'll see what happens. For now, that line has held support and then held resistance several times. So there's clearly something going on around 93.50, and that's something to pay attention to. Looks like the momentum has shifted to the downside for now. So wouldn't surprise me to see a drop to back towards 76, or maybe even just 80 from here. Who knows in the long run? I mean, could easily just bounce today and go all the way back to the 200-day moving average. No reason we can't see some crazy thing happen like that. But I wouldn't count on it, and just something worth paying attention to. Next
Yep.
slide will show you though the XLE, I think. And the XLE will continue to look good as long as oil stays above 60 a barrel. So we got a long ways to go there. But remember, the past couple of weeks, I've been saying selling covered calls around 95 is probably a good play because, this thing's been going up, up, up and away, up, 30 some percent since its recent low at the end of September, and really no pullbacks in sight. So it was long overdue for at least a little bit of a breather. And so selling covered calls but maintaining a long position is a really great way to take advantage of something like that, that you don't want to bail on. But now looks like momentum's rolling over to the downside. We broke
Yep.
the trend line a little bit, and we put in a double top from the highs in June. So for me, um, I'd like to see this thing come down and continue to consolidate somewhere above the 50-day or maybe even just above the 200-day. But just keep on trucking because these things are still cheap. They've got great momentum. They're up a lot for the year. I don't know, 60% probably, roughly. XLE for the year is my guess. I can't remember. Let's see. I'm just going to look real quick. Yeah, 61.60 is what XLE is up for the year. The rest of the market's down, as we just looked at, substantially. So anyway, XLE is looking great. Great opportunity to sell covered calls over the past couple weeks.
Yep. And then here's a not so great chart. So Bitcoin, I don't know the stats on this, but boy, it put in a record sell, that's for sure, the last 2 days. And this is why, buying things in downtrends can be a risky business. Um, Shane, I don't know what you got to add on this. Maybe you can talk about the news behind some of it, or we'll
Yeah,
get to that later.
we're gonna come. We got some slides for that later, but this guy, the Sam Bank Run Fried, is what we call him. Bank Run Fried, not Bankman Fried. Um, he's probably going to prison. And actually, just a few minutes ago, he was out on Twitter saying, "I'm sorry. That's the biggest thing. I messed up. We'll say messed up instead of what he actually wrote. I messed up and should have done better." He'd have 20 point thread, it looks like. At some point, I might have more to say about a particular sparring partner. But glass houses and all. But yeah, this guy, Sam Bankman-Fried, he'd been testifying in Congress and saying how people should trust him to do his own in-house clearing. And turns out he's a total fraud, or at least partially a fraud. And a lot of people are going to lose a lot of money and create liquidity issues within the crypto market space. And I mean, this was a headline that probably drove Bitcoin lower, but it also matched up very well with the technicals. Like once it broke that purple uptrend line and then broke the 50-day moving average, I mean, it was just off to the races, and it broke the 17,500 level that I was watching. So I no longer have a position in crypto. Unfortunately, gave back a little bit of the small profits that I had in there, but it was a small position, so no big deal. And now I don't know, put that 13,800 back into play, which is
Hmm.
our original target for an 80% drawdown from highs. So yeah, pretty nasty, and who knows where it'll end up. But I am out for now, and we'll look for a constructive spot to maybe get back in. But for now, the trend is lower, and not much to get excited about in Bitcoin either.
No. So, and then here, Shane, this has been our rock star chart. This was the 10-year yield. And we broke that uptrending trend line, which it makes sense. You just simply can't continue at that pace.
Yeah.
So came back here, hitting the 50. My thoughts are we'll probably consolidate here for a while before we make a move higher if that's where we're headed. We'll see, but it's probably just going to kind of move sideways for a while and catch up with itself. What are your thoughts?
I think it's been going sideways for I don't know, several weeks it looks like now, right? Since about the middle of October, was the last time we put in a high, and it's holding above the 50-day moving average for now, which is good. So I'd like to see that kind of hold. 200-day moving average is a long ways down there. So, yeah, I don't know. I'm not really seeing anything one way or the other that would lead me to believe it's going to continue going down. Like I think the momentum has been negative for long enough that it probably deserves a tick back higher. But whether that means it'll run and put in a brand new all-time high, I don't have a ton of confidence in it. So yeah, I think I'm with you. I think sideways consolidation from here is probably the most logical outcome, given that the Fed's going to keep hiking rates. The market knows that the Fed's going to keep hiking rates. I think there's a limit to how low this can go. But I don't think there's much of a limit to how high it can go.
Yeah.
So, but yeah, sideways for a bit longer, some good consolidation seems like the most appropriate expectation. Even though we did just put in a lower low, I don't know. That kind of leads me to believe it could easily go lower too. So, yeah, that's a tricky one. I wouldn't if you get to trade 10-year yields, I'd probably stay away from this one for a while until a better trend develops. So,
Yep, I agree. And here's the big one behind all that. So with rising rates, the dollar has been on an absolute tear. And I saw this today and it looks like you caught it too, Shane, but we had this support line that's been going up. We broke down through it for a lower low. What's your takeaway where you think this might go?
I mean, the trend is lower at this point. The long-term trend is higher, but the medium-term trend is lower. We're below the 200-day moving average. We put in two consecutive lower highs after the alt or the cycle high. We've put in three consecutive lower lows, assuming it closes, down here at this area. And we kind of broken the trend that goes back to February. So to me, the most logical thing is that it continues to grind its way down as the 200-day moving average continues to go higher. Maybe they meet, around 106, 107 area, and and then kind of reevaluate from there. But to me, this thing looks like it's going a bit lower. Um, we'll see, as the Fed raises rates, the headlines might trump the chart here and kind of send things higher in a hurry. So you have to be you have to be on the lookout for that. Just like you're seeing stocks rise by 5% in a day, you could wake up tomorrow morning and find out that Europe starts cutting rates again, and the Bank of England backs off of its rate hikes and does some type of quantitative easing. Um, if you see that kind of thing, the dollar will spike higher, and as the dollar spikes higher, the market will give back its gains it's seeing today. So, um, it's no different. That's the danger of trading markets is they can move violently and quickly, especially during, recessions and bear markets and things like that. Um, but for now, if I just had the chart to look at, if you took the symbol off, I'd say this thing's going lower.
Yeah, I tend to agree with you there. So we'll see what happens. But yeah, this is the big one here. We talk about this, we can just hit on it quick, but inverted yield curve, we are back to the .com lows and below those even. So still just looks ugly out there.
Yeah, if the banks were actually paying the short-term rates that correlated with this, they'd be losing more money than you can imagine. But as far as I can tell, the banks are still paying about 0% on checking accounts, and their customers aren't making them do anything different, which is
Yeah.
crazy to me. If you have money sitting in a bank account earning zero, just so you know, you could buy a US Treasury for 6 months and get like 4%. So what's better? A 6 month commitment? And why buy CDs? CDs aren't even paying that much. But
Hmm.
you literally 6 months, 4% in a US Treasury. You should go do that. Like, I don't, if you have like that's a good spot for your emergency fund. I'm
Yeah.
not, this isn't me being crazy here. That's just what you do. Like it's a 6 month US Treasury. That is cash. Anything that matures in less than a year in the U.S. Treasury market is basically considered cash. Even if rates spiked tomorrow, a 6 month Treasury yielding 4% is not going to lose that much in value, if any at all. You're going to be able to convert it to, you know, checking account cash very quickly without much risk. I mean, very, very little risk. It's called the risk-free rate for a reason.
Yeah.
So if
And
you can get 4% in a risk-free rate and you're getting 0% in a checking account, call Kyle, call me, whatever. We'll help you figure out the best way to go buy some US Treasuries and get 4% instead of 0% and and tell your banker, say like, dude, pay me 4%. If they're not willing to pay you 4%, then go get 4% on your own. I don't know. The banks aren't going to start paying more on checking and savings accounts until people start realizing like that they're getting robbed.
yep.
And so, yeah, you should go take advantage of that.
Yeah, that's the big one. Banks right now, people are complacent. They leave their money in a checking and savings, and the bank gets a very nice, cheap lending source so they can go earn a return on that. But once people kind of wake up and start moving funds out, then you'll see rates go up. But right now, it's not really changing. So probably the only thing keeping them alive if you look at the yield curve dynamics. So, and then Shane, here's a big one. So we got this wrong, but that's technical analysis. You want to know risk reward. And this one, you could see it breaking down. You got a tight stop right in there if you were to have taken that trade. It's breaking up instead, and boy, it looks bullish. What are your thoughts?
Yeah, I wouldn't get too carried away on that. I mean, obviously you missed it. If you wanted to buy this for the move up to the highs, because the prior high is like 3.78, right? And we're at 3.75 now. If you wanted to buy it at 3.5 and catch that quarter increase, which is, I mean, don't get me wrong, that's a what, 3.5, that's a 7% bump. You would have had to buy it the moment it broke out of that wedge, and you'd be taking some of your profits off right now because you're running into that other recent high that I have marked there. If
Hmm.
it gets through this, it's going to go back to the 200-day moving average probably. So, you got another opportunity to buy another breakout there. And then if it gets through the 200-day moving average and holds at the 200-day, you're going to have another opportunity to buy long. So I don't think you've really missed this if you want to trade it on the long side. I think there's some risk at this point to use to seeing this as like, okay, it broke out, it went to the most recent high, and now it's going to pull back and maybe even drop to a fresh low. So I'm not trying to just be bearish all the time. Like it was a pretty chart. It was a very tight consolidation that was over a course of many months, and it did it. It tried to fake you out once. It pulled back within the wedge, and then it broke out again. And that was that you should have bought it if you wanted to buy it. That was a great buy signal, and you could book a 7 or 8% gain from here, maybe a 5 or 6% gain, depending on where you got in. But you should be taking profits, at least a little bit of your profit, 10, 20, 30% of your profit off of that trade right now, and moving your stop loss up to protect the profits you still have in it. And if it goes from here to the 200-day, you sell a little bit more when it runs into the 200-day, because that's going to represent resistance too. So that's how you trade something like this, in my opinion. But just given what's going on in the economy. Okay, so if you remove the symbol from this chart, yeah, I'm super bullish because I know what the symbol is and because I see what's going on in the global economy. Um, we only talked about US inflation, but European inflation hit all-time highs of over 10%. Um, England's inflation is at super high levels. Pretty much everywhere around the entire globe is crazy inflation, and so that's not really great for the copper markets, which is why it's down, as much as it is. So to me, I'm looking for opportunities to sell this, and I wouldn't short it here necessarily, but I'd definitely be taking profits if I had bought the breakout, and it was definitely a pretty breakout. But I don't think it's totally out of the woods yet.
Yep. And it's always important as you're in a trade to always measure risk reward from present, so whatever it is today, make sure that you're adjusting for the fact that now there's a little limited, or there's less upside than there was before. Maybe tighten your risk and bring that stop up a little bit. So, yeah. Now, Shane, here's the big one, real estate. Just, I don't know how it's going to be too positive. So in 2007, there was the high rate, and we're over that right now, over 7%. That's not really a great mortgage rate if I want to go buy a home.
Tick back over 7. Yeah. I mean, it's not terrible if you look at like the 1980 to today average rate. It's probably middle of the range, but yeah, compared to recent history, it's very expensive to buy a home. And we'll get to a slide, I don't know, not too long from now that shows what I think is happening. The Grim Reaper is coming for the real estate market in the form of high interest rates. So we'll get to that one in 3, 4 slides from now.
Yep. And so here's a stock, Shane, if you want to just talk to this one.
Oh, so I just thought this was funny. I mean, I picked on the guys at Morgan Stanley a fair amount last week, but this is just hilarious. I got to look at it again. If you can move your little red dot over to the left-hand side, but a couple months ago, Morgan Stanley, these are the same people that were calling for a dovish Fed and a 10% bounce in the markets, even when the Fed was raising rates last week. Same guys at Morgan Stanley raised their Carvana price target to $420 a share. I bet you if we go look at who underwrote the IPO for Carvana, I bet you're going to find Morgan Stanley on there. I could be wrong. I didn't look, but wouldn't surprise me if they had a part in bringing that company to market and gave it a $420 a share price target when it was trading at, under 100. So that's just absurd. And then yesterday, and this was, oh man, I guess I don't have the date that I made this. This was earlier this week though. So, you know, maybe late last week, maybe it was Friday of last week. But very recently, within the past week or so, they went from 420 a share target to $1 a share. Um, I mean, wow, that's just crazy. So they thought it could go up by, you know, thousands of percent essentially, and now they think it could lose 90% of its $9 or $10 value.
Quite the
Um,
change.
I mean, what do you have to do, Kyle? You're a CPA and a CFA. Well, what do you have to change in your model for something to have that wide of a, a price target? Like,
The
I
big
don't know,
thing,
man.
I don't know the analyst that was covering this one, but there's two things is, are you using revenue, EBITDA, or, earnings as your earnings portion? And then
I
the
can
other
tell you
one,
they weren't using earnings because Carvana, I don't think has ever made money ever. I could be wrong.
yeah.
I'm gonna look right now.
So probably not that one. Maybe I bet they're looking at revenue multiple, but
Probably.
that's the key thing, multiple. So you look at an industry multiple, and as you know, we came from high valuations. You throw a very high multiple on there, and for anyone watching too, that's a great measure of risk. If something's using a very high multiple, you got to stop and wonder, is that really achievable? And that's
Yeah,
probably how you get to 420 is a very high multiple.
yeah, they've never made any money, and yeah, they've never had any net income ever.
Yep.
Just
So
all, just an awful turd. Whoever thought that, buying cars from a vending machine wasn't a gimmick. Sorry. I don't know how that's going to work out in the long run, but doesn't look so good. This thing dropped from $380 a share to literally 981 when I took the
mhm.
screenshot a minute ago. Um,
Well,
my goodness, man.
and
My
then,
goodness.
yeah, the next one here, Shane, you highlighted it, but so there's this new company they just IPO'd, I think, called Meta, or oh no, oh, it was Facebook, that really good company that did a name change and tanked ever since. But
Changing the name.
yeah. So
That's not a gimmick either, I promise. We talked about that one last week. It's down what? By the way, Carvana from its current price would have to go up 3,561% to get to its all-time high. Good luck with that. It's down 97% from then. Anyway, Meta, Facebook was down about 75% from its all-time high, and now they're doing large-scale layoffs. Since I took this screenshot on November 6th, they announced it was 11,000 people that are out of a job. So, real that's a real number. Those I feel bad for those people that they are without a job and, won't be able to, well, it'll be difficult for them to address the insanely high prices in food and energy and other things. Thankfully, there's like 1.7 jobs available for every person looking for a job right now. I don't know if those are white collar jobs or blue collar jobs. I don't know if the people that got let go from Meta are, janitors or coders or what their, executive level. I have no idea. I don't know any of that. But I know that when companies this big start laying off that many people, there's probably more to come, right? Like I, Facebook does make money. They make a lot of money. They've always been extremely capital efficient until very recently, and they started investing in this metaverse nonsense with their VR headsets, and now they're making a product and trying to sell it. That's very different from having a technology software capital efficient business. So um, I don't like Facebook or Meta as much as I once did, and we'll see what goes on from here. But I bet you they're not the last ones to announce, large scale layoffs. I bet
yep,
it's just kind of the beginning.
yeah. And then this next one, so getting back to the Bitcoin story. So this is, I always forget his name, but he's running FTX. And
Bank
Shane,
Run Freed.
you
Bank
can
Run
talk to
Freed.
this
That's his
better than I
name.
can.
Yeah, well, look, you can see in the center there, that's a Slack message from me to a couple of my buddies back on August 19th of this year, where I said, didn't Bankman-Fried basically, I typo here, but called a bunch of their products a Ponzi scheme on national television? If you Google that, you'll find it. He was literally explaining what they do as being like a Ponzi scheme. on like a national financial TV show, and nobody called BS on it back in August. Like it blows my mind. Because that literally happened, and then fast forward to today, and they're insolvent and getting marked down to zero. No, go back.
Oh,
But the little arrow there says 5 minutes ago, and this was earlier today. So this guy is in the news as of yesterday, day before, running a Ponzi scheme and going to zero. Um, he's playing video games. He's playing League of Legends today. That's what he's doing. He's not meeting with his attorneys. He's not. I guess he's out on Twitter apologizing to people too. But he's literally playing video games, which is just a trip. You would think that he had better things to do than play video games, but you could Google this too. There are interviews of him on financial TV where he's literally playing video games during the interview and like just kind of paying lip service to the interviewer. He didn't seem to ever take anything seriously, and it doesn't surprise me at all that he's in the position he's in now. So, yeah, the next one will show you kind of the article from Wall Street, but he's
and
I don't know. He's not scrambling for money. He's playing video games. So I think they have missed the headline here. I mean, they're toast. I don't think any amount of money he can find is going to save them now. And I won't get into the details, but ultimately, right, they created a crypto token and used clients' money to pay for losses and other things. And um, one of the major holders of their created fiat token said he was going to start selling it. It created a run on that token. It dropped like 80%. People started pulling their money out of FTX exchange, and they asked for more money than FTX had to give them. And it's a it's a new bent on a very old banking problem. Like, how many times have we seen this happen in the history of the world? A whole bunch. It's just
yeah,
that this time it happens in crypto. So this is what's different about Bitcoin, by the way, going back to the Bitcoin chart, than any of these other tokens. Like, anything other than Bitcoin can be manipulated, can easily go to zero, can be a total fraud, and you don't really have any transparency or way to know it. Um, they claim that you do. They claim that the blockchain is all public and you can see all the transactions and so on. But everybody could see this about FTX, and now look what happened. Everybody could see that at Celsius, and look what happened. Um, Bitcoin is the one thing that is immutable. I don't think you can fake Bitcoin. Like, I don't think it's possible. I think it's the one, everything other than Bitcoin is an altcoin, even Ethereum. And I think that guy who runs Ethereum is on a different planet too, and it's only a matter of time before that has serious issues. But the original Bitcoin is what it is, and you can't freeze it, you can't stop the transactions from happening, you can't shut it down, you can't outlaw it. There's nothing anybody can do about it. And that is what I think gives Bitcoin its value in the long run. Doesn't mean it can't go down from here. Doesn't mean it can't go down a lot further from here. But I think Bitcoin is at the foundation level is very different than any of these other altcoins and any of these founders who you might think is the next, whiz kid and genius, Elon Musk, whatever. They can all go to zero. I don't think Bitcoin's going to go to zero. Again, could it? I guess it's possible. Anything's possible. But Bitcoin is fundamentally different than any other crypto token out there. And I think it would be a good idea to never, ever, ever forget that.
yep. Thanks for the insight there, Shane. I know you're much more familiar with crypto than I am, so always good to get your insight there. This one you put up is pretty self-explanatory here, but
Yeah, well, I mentioned earlier that 7% mortgage rate meant real estate was going to crash. So you got Powell knocking on the door to kill the real estate market, and it's down a lot already. But 7% mortgage rates are exactly what are needed. If they go higher, it's just going to get worse. So the Fed has already killed crypto, stocks, and bonds. Real estate is on deck, and I just thought that was a funny way to look at it.
yep. And then this next one, the most bullish news we have. So as you know, in our last show, we just talked about the Phillies. If they won the World Series, you're going to have a financial crisis based on, correlation. And they didn't win. So all good news there.
All clear, go long, 5% upside in one day. You know, it's probably all just because of the World Series being over. So now the market can finally rally. And I don't think we have anything from the Babylon Bee this week. I think there's one more slide, but
I
it's the
think,
same one as
yeah,
last
we
week. So
same as last week. So if you guys want
believe
to
it or
read
I
it,
don't know if you guys know this or not, but there was an election this week, and so pretty much all the headlines from the Babylon Bee have been heavily political and not economic in nature, and so we couldn't find any new ones, um, but this one was good, so it's up there. If you didn't see it last week, there are 15 job qualifications to work for the Fed. I thought, yeah, I thought 8, 9, 9 was probably one of my favorite ones because economists are always on one hand and on the other hand. That's how they speak, man.
yeah,
So anyway, is that it for this week?
that is it. So Shane, thanks again. Fun day. I don't know what the market's doing now, but it's probably still holding on strong. And
Yeah, it's making a new high.
yeah, so we'll see what happens. But big day doesn't mean it's a big year. So it might flip right around from here. And that's probably what's likely to happen, but you never know. So manage risk and hope to see everyone next week.
Later, Kyle. Thanks, man.
Later. See ya.